that is the dividend yield. This we have seen. But what is given? Price earning ratio. This is given. That okay, Sami got the answer. Uh, See here, it's like this as such. What you need is dividend yield. What is dividend yield? Dividend yield is equal to dividend divided by price. Dividend per share divided by price per share. That is the dividend yield. This we have seen. But what is given? Price earning ratio. This is given. That is given as 12. And payout ratio is given. That is dividend divided by earnings. That is given as 0.6. If you look at these two, you don't even require this third one. I mean, you don't require that actually. So P by E is equal to 12 and D by E is equal to 0.6, and what you need is D by P. So both these are having the same denominator. So if you just divide this by this, this by this, you will have the same number like B, because divided by E is there for both. So you will have 0.6 divided by 12. That is the answer, right? Isn't it? 0.6 divided by 12, that is 0.05. That is 0.05 is 5%. Did you understand it? If you take this P divided by E divided by D divided by E means multiply by E divided by D. Multiply by the conjugate, reciprocal. So E cancel. So what you are getting? No, 1 minute. I did something wrong. P. No, you're not. But you are just dividing it by that, right? 1 minute. Let me clear this. Anyway, this was a very strenuous task to delete it, but because I embarked on it, let me finish it. Okay, completed. Now let me get the pen. It's given price earning ratio. What is price earning ratio? Price divided by earning. It's given payout ratio. That what is payout ratio? D divided by E. And what is needed? Dividend yield. That is D divided by P. So if you divide, D divided by E divided by P divided by E is D divided by P, because both are having common denominator of this. So it is like this, D this thing into if E divided by P. So E is gone, D divided by P, you will get it. So you know that. So you can just take D divided by E, which is 0.6, P divided by E, which is 12. When you divide 0.6 by 12, you get the answer, 0.055%. Have I given a poll? No. So, anybody has got a doubt on it? Anyone has got doubt? Rehna, you are okay with this computation? Okay, next question. I think that's the last question. If the capital gains were taxed at a lower rate than the regular dividend income, then the higher the dividend payout percentage of the company, then the higher its stock price, lower its book value, lower its cost of equity, all that it is coming there. But I don't think actually I have discussed this question as such when I was discussing the dividend dividend consideration, I had just given you only the formula, right? See, I told you that there are many capital structure theorems. Some of the theorems say that dividend is irrelevant because if you compute the total shareholders return, that is dividend yield plus the capital appreciation, I said. So that is the total shareholders return. And if capital gain is taxed at a lower rate than dividend, people will prefer capital gain. If dividend is taxed at a lower rate than capital gain, people will prefer dividend. That is the natural now, because they want to have the they want to maximize the after tax return, right? So if the capital gains tax, if the capital gains were taxed at a lower rate than the regular dividend income, then the lower the dividend payout ratio, then the lower the dividend. I'm not looking at the choices. I'm just taking you to the concept. If capital gains were taxed at a lower rate than regular dividend income, then the higher the dividend payout ratio, right? Uh, the people will dislike that company. If that is the case, they would require higher return from the equity. So if the dividend payout ratio is higher, the capital gain is taxed at a lower rate than regular dividend. So what is the preference? Capital, right? So this company, if they are giving higher dividend, then the investors would require more equity, the cost of equity, right? More return from their equity, because to compensate for the taxation, right? So higher dividend payout means higher cost. Same thing, lower dividend payout means lower cost. So C is the answer. You understood this? You understood the situation? If capital gains are taxed at a lower rate, the preference. See, the cost of equity is a manifestation whether they like it or not. If the practice is something which they don't like, which is adverse to them, they need more return from the equity. That is. So the higher the payout ratio, right, the higher will be the cost of it. The lower the payout ratio, the lower will be the cost. That. So here that's what is given. So that is the way you need to really think. So that is over. Now I will go through study unit 3. Do you have any doubts so far? You can ask, including the question we have just discussed. Any of you want to ask me? You can ask. Think of it, just turn the pages. If you have any doubt, you ask me, but I am taking half a minute break. Okay, let me start. Study unit 3, activity ratios and special issues. Here the first subunit is about the activity ratios. Then we will just recap of the ratio analysis, limitations, and the characteristics of the usefulness of that. That's a general discussion. We already had that discussion, but we will wrap up that. That's a good way to wrap it up. But first, the activity ratio. Like whether you are efficiently running the organization or not, it's really seeing with the least level of investment, you should have more activity there. What is the activity? You will see it in the financial statement, in the income statement. The very good indication of the activity level is the turnover, the sales. So how much sales you are having for a given level of investment. The higher is it, the more efficient you are, the more productive you are. Like for given level of investment in working capital, are you having like very high sales? Like what is the sales level compared to the previous year? Are you increasing it? Compared to your peers, are you increasing it? But then you should understand that when you want to accomplish a high amount of sale with a very low amount of working capital or investment, then you are over trading, right? Over trading means you will have some disruption, means you may be in trouble. That means you are undercapitalized because you don't have sufficient capital. You should be worried about it. If there is any shock, any fluctuation, you will not be able to take that shock. But then if you can reduce the investment for a given level of activity, then you are becoming more efficient, you are becoming more aggressive. On the contrary, if you are having too much investment for a given level of activity, then you are becoming very conservative. It is less risky, but the profitability will be suffered. So you need to have a trade-off between all these things. But anyway, let's go into the concept of activity ratios. For a given level of assets, how much is the activity you are having? That is what is called asset turnover ratio. This is turnover. Turnover is nothing but the net sales from the income statement divided by assets. But here the sales is for a period. So asset is at a particular point in time. So you need to have an average of the assets. So average asset. How will you find the average asset? If you are an analyst, then normally you will have only beginning balance plus the ending balance from one published financial statement itself. Luckily, you will get that for the year. So you will take the beginning assets plus ending assets divided by 2 is the average, right? But then you have an issue there. Sometimes the year-end numbers may not really represent the correct asset position during the year. You know, like some industries are seasonal. So the what is getting published in the financial statement may not really reflect the asset position during the whole year. So in that case, actually, as a general analyst in the economy, probably for the listed companies, you will have the quarterly numbers. Interim financial statements are filed with the regulator. In United States, the regulator is SEC, Securities Exchange Commission. There, the companies are supposed to submit 10Q reports, right? So that is a quarterly basis report. So from there, you can take quarterly asset number. So you can get all the 5 numbers and divide it by 5. You will get an average. Why did I say for 5? When there are 4 quarters, you have the beginning of the year, then end of first quarter, end of second quarter, end of third quarter, end of fourth quarter, 5 numbers. 5 numbers divided by 5 will give you average. That is a better average for seasonal industries than just relying on beginning and end. Similarly, if you are having like it's a bank, then this quarter end numbers will not make any sense. Even month end numbers also will not make any sense if you are analyzing cost of funds all that. You need daily average. In fact, most of the banks publish that daily average, annual daily average, right? So that's a very pertinent information in their systems because sometimes they pay interest based on average balance. They charge customers based on inadequacy of the average balance. So that's there available in their system. That sensitivity is there for that industry. Then the average may be daily average. But a seasonal industry, probably a quarter end number would be all right. But then if you feel that that is not good enough, you can approach the company for a month end numbers, and then they may be publishing for internal reporting month end numbers. You can get that. So you probably, to get a finer number for the For any of these ratios, when there is an average involved, you may have to go for that. But in an examination problem, sometimes you may not even have the beginning balance. If there is no beginning balance, you have to take net sales divided by assets. But if there is a beginning balance given, do not forget your answer will not be correct unless you take beginning balance plus ending balance divided by 2. So whenever the ratio involves an income statement number and a balance sheet number has to be average, then only the numbers will be compatible. Another point I just wanted you to really appreciate that, there is a concept of natural business here. In many jurisdictions, the companies are not free to choose their fiscal years. They have to, in India, all the listed companies have to follow 1st April Fool Day to 31st March. That is the financial year for them. Assume that you are a school. What is your natural business year? 31st March in Kerala. The schools close on 31st March. That's a natural business year. That's right. Natural business year means actually the activities will be very lean towards that period. So that means your asset level, especially the working capital level, will be very low. Now we are going in this activity ratio, we will be concentrating on working capital ratios. So there the working capital will be least around the natural business. So you should be clear about that. So whatever you find as the receivable may be practically zero for a school or a college at the end of the academic year because they would have collected everything. But then that doesn't mean that they don't have a receivable. They have a receivable, but that is too high initial months. But then gradually it comes down. So the year-end number, year beginning number and year-end number may be practically zero, so that may not reflect the reality. So you should be careful about that. So this is an example of a seasonal industry. So there the averages may not be correct if you just take beginning balance and ending balance from the published financial statement, like in the case of a school. And if you are having calendar year as the end of the year, the same issue you can see in industries like ice cream industry and all, where during that time there is a lean period for them. Normally, natural business year is considered as the year ending that lean period. That is so that during that time the working capital level at least will be very low. That is okay. Anyway, now we are talking about asset turnover ratio. Net sales divided by average asset is the asset turnover ratio. So the higher this for a given level of investment, for $1 of investment, how much is the sales you are having? That is what you are trying to see. The higher it is, the more aggressive you are, the more productive you are, the more efficient you are. So it's an efficiency ratio, right? But then what is the issue? Like you are already at the brim, so any drop in asset you will not be able to take it, and if there is any potential also you may not be able to grab it. So that is the issue. So this is a situation of under capitalization or over capitalization when the turnover ratios are high. So under capitalization or over trade, that goes hand in hand, right? So here net sales divided by average. Now now you understand this ratio. So working capital turnover ratio. What is the ratio? Net sales divided by average working capital. What is working capital? Current assets minus current liability is taken as working capital for an accountant. But actually that is net working capital, but that is normally referred to as working capital. Net sales divided by average working capital. How do you compute current asset? Current asset has got different elements. You will have to add up that. Minus current liabilities also may be having that. You have to add up that. You take the difference. That itself is a computation. Sometimes in a problem means you will be given only year and number. So you may not have the numbers, means you will be, instead of average, you will be going for end of period working capital. So you have to work with whatever number you have. But the correct formula is average working. If there is a beginning working capital and ending working capital given, fine. But otherwise, if there is too much computation, sometimes the examiner may not really expect you to really compute the working capital at the beginning of the period and ending of the period. Sometimes the choice may not even tie up with that because they want to ease your life, not harden your life. Okay, so this is the working capital ratio. Now you can go into every element of working capital and then come to the turnover ratio concept. So that is what. So what are the working capital elements other than the cash? This is receivable. I gave you a concept of the operating cycle, if you remember, but I will again touch upon it, right? Uh, the operating cycle versus cash cycle, all that I have mentioned in the class, and I gave you the computation. Then that time I was telling you that I will not go in detail about that, right? The current asset, non-current asset classification. When I explained you what is the current asset, how is current asset defined? Assets which are expected to be realized in cash or sold or used up in business in the longer of 1 year or operating cycles. There I explained you the concept of operating cycle, like the cash to cash cycle. Then I explained you the concept of cash cycle, how it is different from operating cycle. When you subtract the vendor's credit period from the operating cycle, what you get is a cash cycle. So cash cycle is net operating cycle. Cash cycle can be called net working capital cycle. Similarly, operating cycle can also be called working capital cycle. So I have explained you that concept. Now we will do some problems regarding those concepts. Anyway, before that, receivable is one element of working capital. Another element of working capital is inventory. Another element of working capital, as the current liabilities go by, accounts payable. So these are the main three elements of the working capital: accounts receivable, uh, inventory, and accounts payable. So we will really see how the turnover ratio concepts are applicable, what all related computations you can do, and what are the potential questions. That's what we are going to learn today. So receivable, when you see it, I think you can read it as receivable. But 1 minute, let me take this. Take the. Oh, I have the textbook here, right? Receivable. Receivable. First of all, like receivables are getting generated when you are having credit sales. So in the numerator, it is not net sales, it is the net credit sales coming. This is a common error we all do. Receivables, whenever you go for receivable turnover, the turnover compatible with the receivable is the net credit sales. Credit sales, not the total sales. Cash sales is not resulting in account receivable, so the numerator will only be net credit sales. You have to adjust for the cash versus credit component, and you have to take only the net credit sales, not just the number from the income statement. Right? In the absence of information, you might assume that 100% of the sales are credit. If there is a credit, who will not avail? Because account receivable is normally free credit. You and me are not given free credit. That is the reason we go for paying it. Right? When there is a charge, it is different. But account receivable is normally not interest bearing. Right? So people all will be taking it. So in the absence of information, net sales is net credit sales. But if they say that 10% of the sales are on cash, means only 90% you should be taking. You should be very careful about that. And then denominator is the average account receivable, beginning account receivable plus ending account receivable divided by 2 is this. So this is like it's a good indication of for $1 of investment how much credit sales you are making. The higher sales you can generate for invest, because any investment in account receivable is not revenue earning. You are not even charging interest, so it is not revenue earning. So you should give credit only to the extent you can generate sales, additional sales. That means to withstand the competition, you have to extend credit only to the extent really needed, not anything more than that, because it is not value added. Your profitability will be affected, because for that level of investment in account receivable, you have to take a loan and you have to really wait for that money to come. So that means you are incurring an opportunity cost of capital. So you should be trying to maintain lower level of investment in all these things, but at the same time you should ensure that the activities are continued without any disruption, and people should be buying your goods. All those considerations are there. So you should be having an eye, like, subject to the disruption of the business. You should not be too aggressive. So subject to your comfort level, you should be trying to increase the net sales, the net credit sale, then your account receivable turnover will be high, right? You can increase the profitability. And subject to all those conditions, you should try to reduce your account receivable. Then also your account, so a ratio will be increasing if the numerator is increasing or the denominator is decreasing. If the numerator is increasing and denominator is decreasing, then you will not be able to really see, because both are in the sorry, if the numerator is increasing, the ratio will increase. If the denominator is decreasing, then also ratio will increase. If the numerator is increasing and the denominator is decreasing, then definitely ratio will increase for sure. For a given level of receivable, if the sales is increasing, definitely you will turnover ratio will increase. For a given level of sales, if the denominator is reducing, then definitely the turnover ratio will be increasing. But if the credit sales and account receivable both are increasing, then one is in the direction of increasing the turnover ratio, the other is in the direction of decreasing. Similarly, when both the numerator and denominator decreasing also, you will not be able to make any conclusion regarding that. But then what percentage it is increasing, all that you have to apply to the number given, then you will be able to. But otherwise, you will have a confusion. So you should be having it in mind, all these things, right? So you have this ratio, net credit sales divided by average account receivable. Here, if you want to increase this ratio, you should try to get your receivable collected as early as possible, because the lower the denominator, higher this ratio. So how can you do that? How will you really, because if you don't give credit, then you will not be able to get sales. So to maintain that sale, you have to give credit. After giving credit of 2 months, if you want to really reduce the receivable, what is the other way out? You have to give cash discount. Normally you will be seeing something like this: 210 net 60. What does this mean? This means that the normal credit period is 60 days. You will not be charged any interest. Like everybody is given in the industry, we are also giving. So customers are happy. But you want to reduce this 60 days credit period, because you know that you will not be able to run that much investment in receivable. So you will offer a 2% discount if the customers are paying that invoice in full in the 10 days, 10 days from the invoice date. That's the meaning of 2 by 10 net 60. Sometimes you will see 210 comma 60. Like there are many ways to see, but normally you will see 210 net 60. That's a credit term. Credit term. It's published in the invoice. What does this mean? You will get a 2% discount if you pay the invoice in full in 10 days. If you pay the invoice in full. If you pay partly, that is not there in the terminology. That, okay, if the question says that part invoice also you will get 2%, then it's different thing. But as an abbreviation, this means that you are given 2%. That means 98% of the invoice value is all what you require to get this 2% discount. Right? So if you pay it in 10 days, you need to pay only 98% of the invoice. Otherwise, you can pay any time before 60 days. You will not be charged any additional penal interest. That is the meaning of this. So net 60 basis means 60 days is the credit period. Normally you will see that people are paying, but some people may not be paying. Then those accounts are delinquent. They are past due accounts, right? So that's a problem. So if the longer you give the credit period, the higher chances that people may default on that, basically because people just think that okay, we will pay, we will find some source in 60 days time, but they may not find any source, or they may be having some capability, but then their capability would have ceased because they would have met with some accident that they lost their earnings, so they are not able. So they either they are, or sometimes like they may be unwilling to do. So they may be unwilling or incapable of making the payment. That eventualities can come in like eventualities can come more often. I mean, the chances of eventualities are higher if you give longer period of credit. So that danger is there if you give longer period. Your default, the bad debt incidents also can be higher, right? So you should try to minimize your credit period. Only like the industry averages, all that, you have to really stick to that. If you give less credit period than your peers, then your sales will be affected, so you have to give that. But then to accelerate the payments, you can give this kind of cash discounts, 210 net CC or 310 net 90. Meaning what? Normal credit period is 90 days, but if you pay it in 10 days, you will get a 3% credit period. So what is the impact on this on cost of funds? All that it is there in another working capital discussion. Thomas Matthew will be taking it. That time you will be very clear about that. But now I just wanted to really get you familiar with this this creditor. So if you are given 2 months time, then naturally those who are sensitive about the interest, they will be paying only at the brim of that exact 2 months end they will be paying, right? And if you are giving say 210 net or 220 net 90, then exactly on the 20 days only people who want to avail this, because they are also sensitive about the cost, will be paid. So if you want to if you are giving more time for cash discount, naturally your collection period will be increased. What is collection period? Collection period is the average period customer take to pay your receivable, pay your dues. That's the average time the customer take to pay. Or in other words, the average time you take to collect the receivable. That is the average collection or debt collection period. That need not be same as the credit period you have allowed. It may be more if your customers are defaulting. Normally it is more because maximum they will pay on time, and after that. Sometimes if they are paying earlier, definitely the credit period will be, the collection period will be, debt collection period will be less than the credit period amount. Okay, so if you want to reduce the receivable, you have to give cash discount. Cash discount period, if you suddenly increase it, that many days collection period also will increase. So you should really see this. But the collection discount, this 210, that is only for prompt payment. The receivable, the sales is not going to affect, but the receivable will come down. So if you give a cash discount, your receivable turnover will definitely increase because the sale is not going to get affected, right? But your receivable value will come down. So when the numerator is not affected, the denominator come down, the ratio will increase, right? Definitely. So receivable turnover ratio, account receivable turnover ratio is equal to net credit sales divided by averages. From here, what is very pertinent is the information regarding the collection period. So, what is the collection period? Debt collection period. How many days you really take to collect that receivable? That's the collection period. In other words, how many days of sales are blocked in that sales? I mean, in that receivable. So it can also be called days sales outstanding. How many days of sales is there in the receivable? How will you do that? You know your net credit sales. 1 minute. Your net credit sales is for 365 days. So net credit sales divided by 365 is the average daily sales. So how many days of 1 minute? Uh, 1 minute. Let me think of it. So you will take no. Let me rub it off. Huh? What is happening? Something gone wrong? Okay, I think it is back. Now, how to reduce the size of this? Let me try doing it. No. Let me come out of it and come back. Please be patient. Sorry about it. So I was discussing the average collection period or debt collection period. This is number of days sales outstanding, DSO, right? Or this is the debt collection period, this is the days sales outstanding, this is the average collection period, right? So how do you do that? This is equal to, for your net credit sales, no, you are having 365 days for the credit sales. So into how many days you will be requiring for net credit sales in the published financial statement, you have taken 365 days. So how many days of sales are there in the receivable? So on an average, if you want average receivable. So that is the formula for that. So you have a formula. 1 minute. Let me just take that. Anyway, it's not there. So you understood this concept for the credit sales as given in the financial statement. You need 365 days to generate that. So how many days are there of the sale is blocked in the average receivable. That's what you are trying to see, this page number 65. No, but this form is not there. That is the thing. Page number 65 you have, but this form is not there. That's what I'm trying to say. So from here, the DSO, day sales outstanding, is equal to, you have 365 days for net credit sales. So what is the period for average receivable or ending receivable? That is it. That is the average collection period, right? Now you can just rearrange this 365 divided by net credit sales. You can take this average receivable to the denominator, then it will be net credit sales divided by average receivable. This is net credit sales divided by average receivable is what you have just seen, that is the receivable turnover ratio. 365 divided by receivable turnover ratio. So collection period is equal to 365 divided by receivable turnover. So if you want it in days, you have to really divide it by 300. You have to divide 365. So this is in days. This is day sales outstanding. So this is the, let me take it as collection period. If you want it in days, this is the formula. Number of days in the year divided by receivable turnover ratio, right? If you want it in